Can you just address, just before we get into the question, why people are so obsessed with the idea of staying in it for the long haul?
Marketing. Billions and billions and billions and billions of dollars of marketing to get us to feel like investing is synonymous with the stock market. Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. If you have the money to pay off your loans, is now the right time? Are you worried about what will happen to your retirement plan in the upcoming years and what you can do to protect your money and improve your cash flow? Does it make sense to keep putting money into a plan while you owe money on loans? You're going to find out today, Stovall. Let's do it.
Yeah, let's do it. Let's rock and roll. There are still questions about what people should do with money in their 401k, concerns about the stock market. This year, there's been really big lows in the stock market, and then people
been volatile.
Yeah, it's been volatile. And I'll read articles or hear people talk like, if you just stay in it, it bounced back up. Do
you have more money in the stock market than me?
No, I have zero money in the stock market.
I've had zero money in the stock market since 2000.
Yeah, so I don't really pay much attention to it because I'm not bound to it with my money.
My businesses have grown faster than the stock market, so I'm happy.
Yeah. Can you just address, just before we get into the question, why people are so obsessed with the idea of staying in it for the long haul?
Marketing. Billions and billions and billions and billions of dollars of marketing to get us to feel like investing is synonymous with the stock market. Hey, Amanda, it's the American dream that you fund these companies. They're blue chip, they're stable. You just diversify, and it always goes up. The market goes up, the market goes down, but the market always goes up. And there's compound interest that's going to take you there. And you just dollar cost average by buying every single month, high and low, and it has an average price. And you're in it for the long haul is the greatest excuse for a broker because there's no responsibility.
Yeah.
When does the long haul end?
Never.
When you die.
Yeah. Well, never.
It sounds like a terrible CrossFit workout that you that never ends. The long haul, like you're running up hills forever or something. I mean, it's crazy because Wall Street's not worried about the long haul. They're worried about making money on your money, right? Banks are not worried about accumulation and waiting 30 years. They're worried about cash flow today, right? It's these completely different set of rules, and yet I think that because people feel busy, they feel like money is complicated and it's frustrating. It's like, okay, I said it and forget it. And I just I hope it all works out. Keep my fingers crossed. And, there's times where it feels really good. The 90s was amazing. I mean, that was a decade of just crazy returns and people kind of still relate their returns to being like that. And they take these years that are really good and they think that makes up for the years that are bad. But the reality is when a company goes out of business, you lose that return forever if they are one of the S&P 500s. There's volatility. So if you lose and then they go, oh, you lost 10%, but we just made 10% back. If you had 100 grand, you're down to 90 grand. You earn 10%. You're only at 99 grand if there were no fees, but the fees still come out.
Yeah.
So it's just kind of a philosophy of I don't have time. This is good enough. And misquoting what people think the market's actually going to do because they're quoting averages. They're not taking out in consideration of fees and volatility and companies go out of business that get replaced with a new company and, all those types of factors. And the proof is in the pudding, which is 95% of people are not economically independent at age 65 because we neglect creating cash flow and learning how to build cash flow and setting it aside, waiting for 30 years while you take, whether you believe it takes money to make money, high risk equals high return, you're in it for the long haul. And then when they get there, they're like, oh, wait, interest rates are so low. $1 million is only kicking off $30,000 a year. And it's taxable because I deferred all my tax in a retirement plan. And they find out what was supposed to be a dream is actually a nightmare.
Good summary there. Why do you think, what's so different about the market in the 90s versus current day?
We had a really big technology boom during that time. So the internet was a game changer through the second half of the 90s and also had the dot bomb, if you remember, in 2000 because, and there's also this big kind of influx of money as people moved away from pensions and moved more towards funding your own retirement plan. So people were automatically setting money aside every single month all through the 90s, right? That became a big thing to fund retirement plans, which created stability. And so as you start seeing that interest and hearing the economy's good, more money floods into that. And you have all these companies that were nothing start up and grow quickly. Where in the old days, think about it, like if you had a big business idea back in the 20s or the 40s or the 60s, it took a lot of capital to bring that out there because they didn't have the technology that we do today. And so you'd have to raise capital, which meant it prevented a lot of people from going out there and being able to do this, where in today's world, we have people that started in a basement or in a garage and that started in 18 months, they sell for $1 billion. There's this exponential growth because of the advancement of technology. And what started as a huge benefit can start to become a detriment. The way it becomes a detriment is when technology makes existing blue chip companies obsolete. So companies that have always been around, that you could count on them, but they're slow moving and they have a lot of employees. And when technology comes around, like a good example is like Kodak, right? Kodak decided it was going to be a paper company. And when the digital age came in, they became obsolete. And they went from really high value to really low value seemingly overnight because they didn't advance with technology. So technology is going to disrupt some major companies in the next several years that those companies may not survive, or they're going to be diminished in their value substantially. And people are just sitting with money in that because a lot of the companies that are going to disrupt them are startups, which are highly speculative. A lot of those don't make it, but the ones that do replace these other ones and make those companies where you're like, oh, what? This was a massive company 3 years ago, and today nobody uses it anymore. Like that's the concern that I have. In the 90s, it was a huge benefit. In 2020 to 2030, it's going to be a huge detriment to the set it and forget it blue chip, set money aside in the S&P 500.
What do you mean blue chip company?
Blue chip company is kind of like your big, well-known companies, like your Amazons and IBMs
or Coca-Cola.
The companies that have been, Amazon's kind of a new, kid on the block, so to speak. But like the companies that have been around for really long periods of time and they're household names and, maybe they're on the Dow and that kind of stuff.
Got it. Okay. Good to know. All right. We're going to answer Yimmer's question today.
Now we're getting to a question. I just went off on a little diatribe there for everybody.
I think it's a good part, and it'll help us with this question because Yimmer says, since the stock market is going to crash really bad, that's his belief there. So they say, how about this? I have $700,000 in my 401k. My plan right now, and again, before I lose most of my money there, I want to withdraw $270,000 to pay off my house, and also a loan I have with my 401k. This move would leave me with $28,000 per year since I'm not making any payments. I could use this money to invest.
So what he's saying there is he's freeing up $28,000 a year in cash flow by paying off the loans.
Got it.
So when we look at that, let me just take a moment here. So if we have $100,000 and we pay something off, and that frees up $12,000 a year, to create that amount of cash flow, you'd have to earn 12%.
Yeah.
Now you're not actually earning 12%, maybe paying that off, but the equivalent effect to cash flow, it feels like a 12% benefit. So he's looking at $28,000 a year off of, I don't know if that was $280,000. That's really not bad.
Yeah.
Right? Now, I really recommend talking to an investment advisor. Go to wealthfactory.com/private, where there are investment advisors inside of that network to really analyze what you do to protect if you think the market's going to go down or there is going to be a correction, or how you can navigate this the most tax efficiently. I would highly recommend talking to a tax advisor on that specific, an investment advisor combined with maybe someone that's really good with tax. And those investment advisors a lot of times have those accountants like in the Wealth Factory network. So just a recommendation there. All right, keep going with the question.
Well, I came to the end of it. You just wanted to say.
I just interrupted you and I didn't really interrupt you.
I guess so. Just to reiterate, the move would leave him with $28,000 a year since I'm not making any payments. I could use this money to invest, probably with you. What do you guys think? So
yeah, probably wouldn't invest with me since I'm not an investment advisor. I don't do any assets under management. And really Wealth Factory's expertise is how do you keep more of what you make by being more efficient, save on tax, insurance, investments, and interest. And how do you get your financial house in order so that you plug those financial leaks and you get, in a place where you lower your risk and then really focus on creating economic independence, which is a focus on cash flow.
Yes,
which
absolutely.
to his own kind of credit is he came up with a plan to free up $28,000 a year. So I think that I like the thought process. I think a little compare and contrast wealthfactory.com/private and really having a conversation with someone that's specifically licensed and can look at that situation. But I like the thinking overall, right? And so if I were to cover, just a few things here, I think the next piece is cost of money. So cost of money, as you know, is what's your highest, best sustainable rate of return. For some people, it's just paying off high interest rate loans. Yeah. For others, it's what they can generate with their business. For others, it's what they can generate with real estate. It's depending on what the investment is. And if people aren't really willing to be active up front to find the right investments, well, their cost of money is typically going to be a lot lower. Because you could say, well, I'm going to earn 10% in the stock market, but his assessment is that's unlikely, which that's my assessment as well. And that's speculative. Cost of money doesn't have room for speculation. And it isn't something that you can get just for 1 month or 3 months or 6 months, because my very first investment was I gave 25 grand, put it in an escrow account, got back 50 grand 3 months later to help secure a real estate property. That's a 400% annual return. That's not sustainable. That's not something you're going to find every day. So that's not really my cost of money. That's just a kind of a one-off opportunity. And so that's something to consider as your cost of money. The next thing is the tax ramifications, right? Cashing this out. I feel like taxes are pretty low right now. I think that taxes are highly likely to go up in the future. From 1944 to 1981, they were above 50%. Right now, the top is 37%. We've got $27 trillion in debt in the United States alone. I think taxes could go up. So you can take that into consideration with the tax ramifications. And then just the guarantees of when you save interest, that's guaranteed. When you earn interest, even if it's highly likely, it's still not the same level of guarantee. So if it's equal, I kind of prefer saving the interest, right? Rather than saying, well, but you do have to consider what your liquidity is. So what it really comes down to for him is when he's going to invest this money, where could he invest to create cash flow, and what's his investor DNA?
Yeah.
So what are the values, the things that he really wants to pay attention to? What are the drivers, the things that he's excited about? And what are his competencies, the things he really understands and knows about? And really start to focus there, because you'll become a better investor when you know your investor DNA and you actually focus instead of diversify, because diversification, as you know, is diversification for most people. So
spell that.
Yeah. So another resource that's really good for cash flow and some of these things, wealthfactory.com/megakit.
It's a great
wealthfactory.com/megakit has Killing Sacred Cows, What Would Billionaires Do, and a cash flow guide. But I think the most important thing is wealthfactory.com/private and have a conversation. This is a perfect type of situation for them to help.
Yeah. And I think we can link to another video or two that where you've shared about how to find your investor DNA and the importance of that. So we can link to that.
I brought investment advisors on in some of these videos as well. I mean, look, I passed my registered investment advisory series 65 back in the day, but decided I didn't want to manage assets. It's just, there's plenty of people gathering assets, and I'm not unique at analyzing what things to buy in the stock market. I decided to be unique at making money conceptual and understandable, and cash flow and philosophy. And so that other stuff's kind of a distraction for me. There's other people that we've found that are really good at it.
Yes.
Want to continue the path to be a better investor? Make sure that you're not losing money and taking too much risk? Well, click here and learn about strengths vesting.